Something just happened in the gold market that hasn't occurred in over 4 decades. And if you're holding cash, bonds, or traditional retirement accounts right now, you need to understand what this signal means for your wealth in the next 12 months. Gold just triggered what traders call the fear index. Not the VIX. Not some obscure technical indicator. I'm talking about a specific pattern that's only appeared 3 times in modern history. And each time it showed up, gold didn't just rally, it exploded. We're talking about moves that turned modest positions into generational wealth, the kind of gains that redefined entire portfolios. Let me show you exactly what's happening right now, why the smartest money in the world is rushing into physical gold at a pace we've never seen before, and what this means for anyone trying to protect their purchasing power in what's shaping up to be one of the most volatile periods in financial history. The pattern I'm referring to isn't something you'll find in mainstream financial media. They're too busy talking about stock market highs and economic soft landings. But if you know where to look, if you understand how institutional money actually moves, you can see it clear as day. Central banks just reported their largest quarterly gold purchases in recorded history. Not since they started tracking this data have we seen accumulation at this pace. Think about that for a second. These are the institutions that print money. They control interest rates. They have access to every economic data point before it hits the public. And they're converting their own currency reserves into physical gold at a rate that's accelerating, not slowing down. The National Bank of Poland just announced they're doubling their gold reserves, not increasing by 10%, not adding a modest allocation, doubling. That's not a hedge, that's a statement. But here's where it gets interesting. This isn't just emerging markets trying to diversify away from dollar exposure. The pattern is showing up everywhere. Central banks in developed economies, sovereign wealth funds, pension systems managing trillions in assets. They're all moving in the same direction simultaneously. And they're doing it quietly, through private transactions that don't hit the spot market, using allocated accounts that keep the physical metal off exchange. You want to know why that matters? Because when institutions buy gold this way, they're not speculating on price. They're not trying to catch a trade. They're removing physical supply from the system permanently. They're treating gold like the ultimate form of money, which is exactly what it's been for 5,000 years. And when you see this kind of coordinated accumulation across multiple jurisdictions, across different types of institutions, all happening at the same time, that's not coincidence, that's preparation. Now let me connect this to what's happening in the broader market structure, because this is where the fear index signal becomes crystal clear. Gold just broke through a technical level that's held for over 2 years. We're not talking about some arbitrary round number that looks good on a chart. This was a genuine resistance zone where massive selling pressure had consistently appeared. Every time gold approached this level, commercial traders would short it back down. Hedge funds would take profits. The rally would stall out. Until now. Gold didn't just break through that resistance, it shattered it. And here's the critical part. It did so on the heaviest volume we've seen in years, with commercial short positions at their lowest level since they started reporting this data. That's the fear index trigger. When the smart money that usually suppresses gold rallies suddenly steps aside. When the institutions that profit from keeping gold range-bound stop fighting the move, that's when you know something fundamental has shifted. Let me take you back to the last time we saw this exact pattern. It was early in the previous decade, right before gold went on a run that took it from the low thousands to nearly $2,000 an ounce. The setup was identical. Central banks were accumulating, commercial shorts were covering, and mainstream analysts were calling gold overvalued, saying the rally was overdone, recommending investors take profits and rotate into stocks. Anyone who listened to that advice missed one of the greatest wealth transfers in modern history, because what happened next wasn't a correction. It was an acceleration. Gold didn't pull back and consolidate. It went parabolic. And the people who understood what the fear index signal meant, who recognized that institutional accumulation pattern, they positioned themselves before the real move began. Here's what most people don't understand about gold. It doesn't move like a normal asset. Stocks can rally on earnings growth, on multiple expansion, on buybacks and dividends. Bonds respond to interest rate expectations and credit quality. But gold is different. Gold moves on fear. Not the kind of fear you feel when your portfolio drops 5%. I'm talking about systemic fear, the kind that makes institutions question whether the entire monetary system is stable. And right now, that fear is building in ways most people can't see because they're looking at the wrong indicators. They're watching the stock market hit new highs and assuming everything is fine. They're seeing unemployment numbers and thinking the economy is stable. But institutional money isn't looking at lagging indicators. They're looking at what's coming. And what's coming is a currency crisis that's going to make previous devaluations look like minor adjustments. Think about the mechanics of what's happening right now. Governments around the world are running deficits that would have been unthinkable a generation ago. Not during wartime, not during economic collapse, during what they're calling a recovery. The United States alone is adding trillions to its debt every single year, with no plan to ever pay it back, no intention of balancing the budget, no political will to make the hard choices that fiscal responsibility would require. And here's the thing, that debt doesn't just disappear. It gets monetized. Central banks buy government bonds with newly created currency, expanding the money supply, diluting the purchasing power of every dollar, euro, and yen in existence. They call it quantitative easing. They frame it as stimulus. But what it really is, what it's always been, is currency debasement. And the people who understand this, the institutions managing generational wealth, they're protecting themselves the only way that's ever worked throughout human history. They're buying gold. Now let me show you why this time is different from previous gold rallies. In past cycles, gold would rally when real interest rates went negative, when inflation expectations rose, when geopolitical tensions escalated. Those were temporary factors. Markets would stabilize, rates would normalize, and gold would consolidate or correct. But what's happening now isn't temporary. The structural imbalances in the global financial system aren't getting fixed. They're getting worse. And the institutions that manage the system know it. Look at what's happening with the dollar's role as global reserve currency. For decades, this was unquestioned. Countries held dollars because they needed them for international trade, because oil was priced in dollars, because the U.S. economy was the most stable and liquid market in the world. But that's changing. Not slowly. Rapidly. Trade agreements are being denominated in local currencies. Oil transactions are happening outside the dollar system. And central banks are reducing their dollar reserves at a pace that would have been unthinkable just a few years ago. This is what they call de-dollarization. And it's not some fringe theory or conspiracy. It's official policy in multiple countries representing billions of people and trillions in economic output. They're building alternative payment systems. They're settling trade in gold. They're creating currency arrangements that bypass the dollar entirely. And every time this happens, every time another country reduces its dependence on dollar reserves, that's more currency that needs to find a home. And increasingly, that home is gold. Here's where the fear index signal becomes a roadmap for what's coming next. When you see central bank accumulation accelerating, when you see commercial shorts covering, when you see physical demand overwhelming paper supply, that's not the end of the move. That's the beginning. Because gold doesn't top out when institutions are buying. It tops out when retail investors panic buy at the peak, when your neighbor is talking about gold at dinner parties, when mainstream media is breathlessly covering the rally, and everyone who ignored it for years suddenly wants in. We're nowhere near that phase. Most people still think gold is a barbarous relic, a pet rock that doesn't generate cash flow. They don't understand that gold isn't an investment. It's insurance. It's the asset you hold when you don't trust the people managing the monetary system to preserve your purchasing power. And right now, the evidence that you shouldn't trust them is overwhelming. Let me give you a specific example of how this plays out in real portfolios. Imagine you're managing a pension fund responsible for paying benefits to retirees over the next 30 years. You're looking at your portfolio, which is probably 60% stocks, 30% bonds, maybe 10% alternatives. And you're running the numbers on what happens if inflation stays elevated, if interest rates can't rise enough to control it without crashing the economy, if currency debasement continues at the current pace. Those numbers are terrifying, because in that scenario, your 60% stock allocation might generate nominal returns, but real returns after inflation could be flat or negative. Your bond portfolio, which is supposed to be the safe part of your allocation, is getting destroyed by negative real yields. And your alternatives, your private equity and real estate and hedge funds, they're all denominated in the same currencies that are losing purchasing power. So what do? You can't tell your beneficiaries that their retirement is going to be worth 30% less in real terms. You can't just accept that outcome. You need an asset that preserves purchasing power, regardless of what happens to paper currencies. And there's only one asset in human history that's done that consistently across every monetary system, every empire, every period of currency debasement. That asset is gold. Now, if you're sitting on significant retirement savings, if you have 6 figures or more in traditional accounts, this is where you need to pay attention. Because there's a way to get physical gold into your retirement portfolio without triggering taxes, without taking distributions, without the penalties that normally come with moving retirement money around. It's called a gold IRA, and I put together a detailed guide on exactly how it works. You'll find it in the description below. It covers the mechanics, the custodians, the storage requirements, everything you need to know if this is relevant to your situation. Worth checking out if you're thinking about how to protect purchasing power in your retirement accounts. But let me get back to why this fear index signal is so critical right now, because it's not just about gold going up. It's about what gold going up means for everything else in your portfolio. When gold rallies like this, when it breaks through major resistance on heavy volume with institutional accumulation, that's telling you something about the broader financial system. It's telling you that the smart money sees risks that aren't being priced into other assets. Think about what happened in previous periods when gold signaled this kind of systemic concern. We're talking about the breakdown of Bretton Woods, when the dollar's link to gold was severed and currencies became pure fiat for the first time in history. We're talking about the stagflation of the late 70s, when inflation raged while economic growth stalled and traditional portfolios got crushed. We're talking about the financial crisis, when the entire banking system nearly collapsed and central banks had to create trillions in new currency to prevent a complete meltdown. In each of those periods, gold didn't just preserve wealth, it multiplied it. Because while everything else was losing value in real terms, while stocks were volatile and bonds were getting destroyed by inflation or default risk, gold was doing exactly what it's designed to do. It was maintaining purchasing power. It was acting as the ultimate form of money when confidence in paper currencies collapsed. And here's what you need to understand about where we are right now. The imbalances in the current system are larger than they were before any of those previous crises. Government debt levels are higher. Central bank balance sheets are more bloated. The gap between asset prices and underlying economic fundamentals is wider, and the political will to address these issues is non-existent. Nobody is talking about fiscal responsibility. Nobody is proposing to shrink deficits. The entire policy framework is built on the assumption that we can just keep creating currency forever with no consequences. But there are consequences, and those consequences are showing up in the gold market right now. Because while politicians and central bankers are pretending everything is fine, while they're telling you that inflation is transitory and the economy is strong and there's nothing to worry about, institutional money is voting with their capital, and they're voting for gold, not as a trade, not as a speculation, as a permanent allocation to protect against what they see coming. Let me show you what this looks like in the actual market structure. Gold futures on the COMEX, which is where most paper gold trading happens, are showing something remarkable. Open interest is declining while price is rising. That's unusual. Normally, when gold rallies, you see speculative interest increase, you see more contracts being traded, you see hedge funds and momentum traders piling in. But that's not what's happening. Instead, you're seeing contracts being closed out. You're seeing the paper market shrink while physical demand is exploding. What does that tell you? It tells you that the people who were short gold, the commercial traders who profit from suppressing rallies, they're covering their positions. They're not fighting this move. And the people who are buying aren't doing it through futures contracts that can be settled in cash. They're taking physical delivery. They're moving metal out of exchange warehouses into allocated storage. They're treating gold like the monetary asset it is, not like a commodity to be traded. This is the fear index signal in its purest form. When the paper market steps aside and physical demand takes over, when institutions stop trading gold and start accumulating it, that's when you know the real move is beginning. Because paper markets can be manipulated, futures contracts can be created out of thin air, but physical gold is finite. There's only so much of it. And when demand for physical metal exceeds available supply, price has to adjust, not gradually, violently. We're seeing this play out in real time in the premium structure between paper and physical gold. In normal markets, the spot price and the price of physical coins or bars are very close, maybe a small premium for fabrication and distribution. But right now, that premium is expanding. Physical gold is trading at significant premiums to paper gold in multiple markets around the world. That's not normal. That's a sign that the paper market is losing its ability to set price, that physical demand is overwhelming the system. And here's why that matters for what happens next. If you're a central bank or a sovereign wealth fund or a pension system trying to acquire significant amounts of physical gold, you can't just go into the spot market and buy it. There isn't enough available supply. You have to negotiate private transactions. You have to work with refineries and mints directly. You have to wait for production. And while you're waiting, while you're trying to accumulate your position, price keeps rising because everyone else is trying to do the same thing. This creates a feedback loop that's incredibly powerful. Rising prices attract more attention. More attention creates more demand. More demand pushes prices higher. And unlike stocks, where rising prices eventually hit valuation limits, where companies can issue more shares or where growth expectations get priced in, gold doesn't have those constraints. Gold's value isn't based on earnings or cash flow. It's based on confidence in paper currencies. And right now, that confidence is eroding faster than most people realize. Let me give you a concrete example of how this affects real people. Imagine you're a retiree living on a fixed income. Your pension or Social Security gives you a certain number of dollars every month. That number doesn't change, but what that money can buy, that changes constantly. And if inflation stays elevated, if currency debasement continues, if the purchasing power of your fixed income declines by 3 or 4 or 5% every year, that's devastating over a 20 or 30-year retirement. This is why gold matters for regular people, not just institutions. Because while your income is fixed in nominal terms, gold adjusts for currency debasement. When the dollar loses purchasing power, gold's price in dollars rises. Not perfectly, not in a straight line. But over time, consistently, gold maintains its purchasing power, while paper currencies lose theirs. That's not theory. That's 5,000 years of monetary history. And right now, with the fear index signal triggering, with institutional accumulation accelerating, with physical demand overwhelming paper supply, we're at the beginning of a period where that purchasing power preservation is going to matter more than it has in decades. Because the currency debasement that's coming, the inflation that's being baked into the system by unsustainable fiscal policy and unlimited monetary expansion, that's going to destroy the real value of cash and bonds and fixed income in ways that most people aren't prepared for. Here's what the smart money understands that retail investors don't. Gold doesn't need to be a huge part of your portfolio to make a massive difference. Even a 10 or 15% allocation can dramatically reduce your portfolio's volatility and protect against tail risks that other assets can't hedge. Because gold moves differently than stocks and bonds. When confidence in the financial system is high, when growth is strong and inflation is low, gold might underperform. But when systemic risks emerge, when currencies are being debased, when the monetary system is under stress, gold is the asset that protects you. And we're entering a period where those systemic risks are higher than they've been in generations. Not because of one specific crisis, but because of the accumulated imbalances from decades of kicking problems down the road, of choosing short-term political expediency over long-term fiscal responsibility, of pretending that we can create unlimited currency without consequences. Those consequences are coming, and the institutions that understand this are positioning themselves now, before the crisis hits, before retail investors panic, before the real fear sets in. This is why the fear index signal matters so much. It's not telling you that gold is expensive. It's telling you that the smart money sees what's coming and they're protecting themselves. It's telling you that the institutions with the best information, the most sophisticated analysis, the longest time horizons, They're moving into gold at a pace we've never seen before. And if you understand what that means, if you recognize that pattern from previous periods of monetary instability, you know that this isn't the time to wait and see. This is the time to position yourself before the real move begins. Because here's what happens next in this pattern. Gold consolidates at these new higher levels. Mainstream media starts covering the rally. Analysts who've been negative on gold for years suddenly turn bullish. Retail investors who ignored gold when it was cheaper start getting interested. And by the time everyone agrees that gold is going higher, by the time it's obvious to everyone, the easy gains are gone. The institutions that bought early are sitting on massive profits, and the people who waited are buying at prices that would have seemed impossible just months earlier. We've seen this movie before. We know how it ends. The only question is whether you're going to position yourself with the smart money at the beginning of the move, or whether you're going to wait until it's obvious to everyone and pay much higher prices for the same protection. Because make no mistake, this isn't about getting rich quick. This is about preserving purchasing power during a period of unprecedented monetary instability. This is about making sure that the wealth you've accumulated over your lifetime doesn't get destroyed by currency debasement and inflation. The fear index just triggered. Central banks are accumulating at record pace. Commercial shorts are covering. Physical demand is overwhelming supply, and gold is breaking through technical resistance that's held for years. This is the signal. This is the pattern that's preceded every major gold rally in modern history. And if you understand what it means, if you recognize the opportunity that's presenting itself right now, you have a chance to position yourself before the real move begins. Before the fear becomes obvious to everyone, before the safety rush turns into a panic. The institutions are already moving. The question is, will you?